Hey team, this is part of the What to Expect in 30 Days series that we're doing. This is video number 4, and this video is going to be focused on the in-home. So I'm going to show you guys how I do a virtual Zoom in-home, but it's going to be the same exact presentation whether you're doing it over the phone. Obviously, the client won't be able to see your computer, but it's going to be the same system. You're just going to follow it. And you can also use the same system when you're going into somebody's home. Obviously, tweak it a bit to make it your own, but this is how I do it, okay? So I'm just going to open up my screen and share it with you guys, and then we're going to get started. So we have a presentation that we use. I use the same presentation regardless of what type of lead I call. I just kind of skip through slides based on what I'm doing, whether it's final expense or mortgage protection. But right now I'm just going to do a very basic mortgage protection in-home presentation. So this is how it goes. Okay, so I'm going to pretend that the client's here and I'm meeting with them, and I'm just going to start pretend I'm talking with them. Okay, so I pull up the presentation. Before I pull up the presentation, I will have them on Zoom and I will talk to them a little bit, introduce myself, and then I will let them know I'm going to share my screen with them. And I kind of walk them through the process. And I say, John Mary, I'm going to take a couple of minutes to tell you about the company I work with and the insurance companies that we partner with. I'm going to take a couple of minutes to tell you about myself. And then we're going to jump into some things that I think that you qualify for. But before we do that, I'm also going to ask you some questions about yourself so I can get to know you a little bit more. Some of the questions are going to be morbid, some of the questions are going to be financial, and some of the questions are going to be about your home and your family dynamic. And I just ask that you play along so that I can make sure I'm giving you the best options for your specific needs. Okay, so I partner with a company called Family First Life. We're located out of Connecticut. We have about 10,000 agents across the nation, but I am right here in Wakefield, Massachusetts, so not too far from you and John and Mary. I'm originally from Long Island, New York. I've been doing insurance for over 15 years. Went to Temple University to get my degree, started out working in Manhattan for a very large insurance company and worked there for many, many years. And then I met my ex-husband, who happened to be from Tewksbury, Massachusetts, and that's how I wound up here in Wakefield, Massachusetts. When we moved here and I purchased my home, I have 2 kids. I have a daughter who's 9 and a son who's 8. We got married, we purchased our first home. I got pregnant with my first child. And then right before she was born, I unfortunately lost both of my parents in a tragic accident. And it was very unexpected. They were not sick and they were only 64 years old. And at the time, I had never experienced the price of a funeral before. And my parents' funerals were roughly $24,000. And I did not have $24,000 just sitting around in a bank account. So I thought I was going to have to remortgage my new home to pay for their funerals. But what happened was my father had purchased a small $30,000 life insurance policy. It did come with an accidental death rider built into it. So we were able to get about $60,000. With that money, we were able to pay their funerals, which were $24,000. And we were also able to make a few payments on their home. They still had a mortgage in Long Island. And then we were able to sell the home and then take the equity out of the home and put it in our bank accounts. So all because my father was smart enough to buy a very small life insurance policy. He did not tell me and my brothers about that policy. And if he did, we probably would have told him not to purchase it. But I'm so grateful that he did because it helped me and my brothers out so much. Because we are independent, we can work with any insurance company that we choose to. So the way that we narrow it down is the insurance companies must meet 4 qualifications. So first and foremost, they have to be around for a long time. We don't work with any new insurance companies. So all of these guys have been around for about 100 years plus. They have to have a strong financial backing. So when our clients need the money, they get paid. They have to be A or better rated on AM Best, which is a third-party company that rates insurance carriers. And they have to have somebody that answers the phone when we call and not a robot. So all of these companies fall into those qualifications, and we only work with the best of the best. So John and Mary, we offer lots of products. I do all types of different insurance, from Medicare to health insurance to disability insurance. But this mortgage protection product is by far our hottest product right now. And the reason why is there's a lot of people refinancing their homes or buying new homes because the interest rates are so low. So basically what this product does is it works very similar to a traditional life insurance policy. So in the event of your death, it's going to pay your beneficiary a lump sum of money. It doesn't go to the mortgage company. It goes directly to your beneficiary. And they're going to take that money. It's never taxed. They're going to stick it in a bank account. And that's what they're going to use to make the mortgage payments or pay the mortgage off. Okay, there's 2 products that fall under the mortgage protection umbrella. One product is going to pay off the mortgage in the event of a death or disability, And the second product is going to pay a series of mortgage payments as well as some disability. Either product that you choose to go with is going to be tied to you, not your mortgage. So if you were to sell the house or win the lottery, you're still entitled to the benefit. It stays with you unless you decide you no longer want it. My favorite part about this product is that it comes with something called living benefits. And the reason why the living benefits are so important and what make it stand out above a traditional life insurance policy is that most people don't realize that houses go into foreclosure more due to people getting ill than somebody passing away. Okay, with technology, people are living a lot longer. So they get sick, they're unable to work, there's no income coming in, therefore they can't make their mortgage payments and their house goes into foreclosure. So this product is designed to prevent that from happening. And that's why we offer these living benefits with all of our products. Okay, depending on which one you qualify for, you may get all of them or you may get some of them. So the first one is going to cover you in the event of a critical illness, which is ALS, life-threatening cancer, kidney failure, heart attack, major organ failure, stroke. The second one is chronic illness. You can't perform 2 of the 6 daily living activities. And then the last one is terminal illness, which is just like it sounds if you have 12 or less months to live. If any of those things happen, you will be able to pull money out of the death benefit while you're living to help pay your bills. At this point, guys, I may go into a story about how that's helpful or how it helps a client at some point, but I'm not going to get into all that now. But you can go into a story and just talk about, somebody that had purchased a policy and then they got sick. They became terminally ill. They weren't able to get help because their insurance company wouldn't cover the procedure. So they were able to pull money out of the death benefit while they were living, and that helped to prolong their life. There's a ton of stories out there you can use, or maybe you even have one of your own. I tend to skip this slide, but if you wanted to use this slide, you could. And basically what I say is the best way to predict the future is to create it, so you're not leaving anything to chance. So getting an insurance policy like this is really just replacing your income. The reason why we want to replace your income is because we want your family to be able to make your mortgage payments, cover your final expenses. Maybe you want to pay an education for the kids or the grandkids, make sure your medical bills are paid and your credit card debt is paid off, so your family doesn't have to worry about that. So Mr. John and Mary, what we're going to do here is we're going to review some information. I'm going to ask you guys a couple of questions. Once again, some of those questions are going to be morbid. Some of them are going to be financial, and some of them are going to be based on your family and your house. Okay. All I ask is that you play along, even if the questions are weird, and just answer the questions because that's going to help me decide what you qualify for and how I can best help you. From there, based on your answers, I'm going to lay out 3 options. I always like to do a high, medium, and low. And you guys can pick the plan that makes the most sense for you today and that feels good. And then we're going to go ahead and submit an application to see if we can get you approved. Now, just so you know, we're not buying insurance today. What we're doing is we're just seeing if we can get you approved. Okay. If it was up to me, I would approve everybody. But unfortunately, it's not my decision. The insurance company makes that decision. So my only job is to tell you what you qualify for and help you submit the application. Okay. All right. So here's where we're going to go through a quick financial analysis. And this is what's going to help me determine what you qualify for. So John, what are you doing for work? He's a teacher. Okay, John, how long have you been doing that? 5 years. Okay, John, do you have any type of pension, 401k, IRA, stocks, mutual funds, any family inheritance or any rental properties that would roll over to your family in the event of your death? And John says, okay, I have a 401k. Okay, great, John. How much is in your 401k? 50,000. Perfect. And then John may say, I have a small pension. So when I retire, I'll get paid $2,000 a month. Okay, perfect. So we're going to put that in there as well. And then I'll say, John, do you know if that pension rolls over to your family in the event of your death? And John may say, yes, a portion of it does, or no, none of it does. Okay, so in this one, we're going to say none of it rolls over. Okay, John, anything other than your 401k that you can think of that would roll over to your family in the event of your death? And John may say, okay, I have a small IRA outside of work. Perfect. What's in your IRA? 10,000. Okay, great. Okay, John, any life insurance currently? And John's going to say, okay, I have life insurance through work. How much do you have? I have 50,000. Okay, perfect. Any life insurance outside of work? And he's going to say no, and then I'm going to write no life insurance. All right, John, last question. What is your monthly take home? So after your taxes and all of your 401k health insurance benefits are taken out of your pay, what do you bring home? John says, okay, I bring home $10,000. So this is just a quick financial analysis that we're doing, okay? And then I'm going to move over to Mary. Okay, Mary, I'm going to ask you the same questions. Are you working? Mary says, yes, I'm also a teacher. Okay, great. How long have you been doing that? Also 5 years. Okay, great. Do you have any 401k, IRAs, mutual funds, stock options, inheritance, rental income, anything that you can think of that if you were to pass away tomorrow would roll over to your family? And Mary says, yes, I'm going to go with the same option. So Mary says, yes, I have a 401k and it's also got $50,000 in it. Great. Do you have a pension, Mary? She goes, yes, but it's much smaller. I only get $500 a month. And that does not roll over to my family. Mary, do you have anything else? No, I don't have any other IRAs. I don't have any other stocks. I don't have any rental properties. I don't have any inheritance. I have nothing else. This is what I have. Okay. Mary, do you have any life insurance? Mary says, yes, I have life insurance at work. How much do you have? She goes, I have 50,000. So all I'm doing is asking questions that are on the financial analysis that you guys have there. It's called the financial inventory. You can just kind of read those questions. And all I'm doing is typing it in so they can see it. That is all I'm doing. And if you're on a telesale, you're going to make them grab a piece of paper and a pen, and you're going to make them write it down. So I always tell my clients, if we're on a telesale, can you grab a piece of paper and a pen, and can you put 3 columns? One is going to be for John, one is going to be for Mary, and one column is going to be for the house. And then when I ask questions, I have them write it down just like I'm writing it down. Okay. And then I also write it down while I'm on the phone with them. Do you have any life insurance, Mary, outside of work? She says, no, I have no life insurance outside of work. Mary, what is your take home? And Mary says, my take home is $4,000 a month. Okay, great, guys. Now let's talk about the house. So how much is the mortgage on your home? And they say our mortgage is $400,000. Okay, how long is the term? It's a 30-year term. What are your monthly mortgage payments? Our monthly mortgage payments are $3,000. With insurance and taxes. And then I say, okay, guys, if you were to sell that house tomorrow, what do you think you get for it? And they'll kind of go back and forth and they'll say, okay, we can get $500,000 for it. So then I'll say, okay, that means you have about $100,000 of equity in the home. Perfect. And then I'll start asking about the kids. So do you guys have any kids? Yes, we have 2 kids. And then I'll write it down. What are their ages? 4 and 5. What are their names? Are they boys and girls? I'll just get a little personal because what I'm trying to do is evoke the emotion. So when they start thinking about their kids and I start asking their names and what genders they are, then they're going to start getting a little bit more emotional about it because then they start thinking and visualizing their kids in their heads. Okay. So 2 kids, 4 and 5, Molly and Bobby, boy and girl. Great. And then I'll say, typically I'll say here, what was the reason why you filled out the form? And then they'll say, well, we wanted to make sure our house was paid off in the event of our death, so to protect the kids. Okay, perfect. So then I'll write that down. Want to make sure our house is paid off. For kids. Okay. And then I will say, okay, guys, here's where I'm going to ask you some really morbid questions. And I apologize for this in advance, but this is why we're on the phone today. Okay. And they'll say, okay. And then I'll say, John, I'm going to start with you. John, if God forbid Mary didn't wake up tomorrow morning and now she's no longer there, and now your life is just you and the kids in the house, you know, and you're on your own, what does that look like for you? Do you think you'd want to stay in the house or do you think you want to sell it? And then John's going to say, oh, I would sell it. You know, he's going to think a little bit. He may laugh a little bit. He may get nervous. He may ask Mary. And if he does do that, then you just want to say, hey, John, if you could just answer the question without Mary, because we're pretending that Mary's no longer here. So you don't have the option of asking Mary anymore. So you need to know what you're going to do with that house. And then they'll get a little more serious. And then John will say, okay, I would probably want to keep it because I have my kids. So then I'm just going to write John wants to keep the house. And then I asked Mary the same question. Okay, Mary, what if something was to happen to John tomorrow? You wake up and he's no longer here. Okay, now it's your life without him. Now you have the kids in the house. What does your life look like? Are you going to keep the house or you're going to sell it? And Mary's going to say, no, I want to keep it. My kids live here. I want to stay in the house. And then I say, okay, guys, this one's going to be a really morbid question. And once again, I do apologize, but what if something happened to the 2 of you? You get into a terrible accident, you both die. What happens to the children? Where do they go? What happens to the house? And then they start to really think about it. They're starting to get a little emotional. and they say, well, we don't know, or, maybe we already did a will, or whatever they say, you're just going to write it down. So they say our kids would go with their grandparents. And then I say, okay, would the grandparents want to move into your home, or would they sell it? And let's just say they would want to move into our home. And then I will say, okay, do they have enough money to pay the mortgage on the home, pay all the bills in the home, all the utilities in the home, the upkeep of the home, take care of the kids, food and everything else, clothes, and give the kids the life that you guys would want to give them, college tuition, all that stuff. And they're going to think about it. And typically the answer is no. Sometimes they will say yes, but typically the answer is no. Okay. And then you can write that down. Grandparents okay. So then I'll go from there and I will say, okay, so if they can't afford to stay in the home, they'll probably sell your home, I'm assuming, right? And they're going to need some time to do that because they obviously have to keep the lights on in the home. They have to keep paying the mortgage on the home, because if not, the home goes into foreclosure. So they're going to need some time to make some payments on that home and then sell it. Wouldn't you agree? And they're going to say yes. And then I'm going to, okay, John and Mary, thank you for that information. Really appreciate it. So let's look at some options that I know are going to protect you and your family. Okay. And then I'm going to say the first thing I noticed, you guys, is that we have John over here. He's got 50,000 in a 401k. He's got a nice pension coming in after he's no longer working, and he's got about 10,000 in an IRA. I'll say, listen, this 401k is great, but what happens with this 401k is it's not taxed. So when you start pulling money out of it, it becomes taxed. So if Mary needed this 401k after John passed away and she decided to pull the entire thing out, it's going to be taxed at whatever your tax bracket is. Let's just say that's 30%. So you right off the bat lose 30% of that money. That is not enough to pay off the home. Okay. Same thing with the IRA, depending on what type of IRA, whether it's Roth or traditional, that may be taxed as well. And you don't have to know all this, and you don't have to go into this. This is just what I talk about just because I've been doing this so long, so I'm familiar with it. And then I'll say, okay, and also, John, you have life insurance at work. You have nothing outside of work. So basically you have no life insurance that you own. Your company owns this life insurance. So if you get let go, laid off, furloughed, or if you get way too sick that you can't work, then the first thing that goes is this goes away. So currently you have, as far as I'm concerned, you have no life insurance. So Mary's in a bad position if you were to pass away, because you have some things here that are good, but there's taxes that are going to come out of this. And then you have this, which doesn't count as actual life insurance. So right now you have no life insurance. Okay. And you're the primary breadwinner. All right. So if you were to pass away, Mary's losing $10,000 a month. Okay. We're looking at what Mary makes. Mary brings in $4,000 a month. That is not enough to cover the mortgage, the utilities, the upkeep, and keep the kids clothed and fed. Okay. So she's in a really, really bad position. Okay. We need to make sure she's taken care of. And then I'll say the same thing. Hey, Mary, you're in the same boat, and I'll go through the same thing. And, obviously if you were to pass away, Mary, yes, John is the primary breadwinner. He can pay the mortgage on the home and the bills and all that stuff, and he should be okay. But you have 2 little kids at home. Somebody has to take care of those kids. And chances are you're the one that's primarily taking care of the kids, and John's the one that's primarily working. And I'm getting that information based on how much he's making over what you're making. So somebody's now going to have to take on that role. You're probably going to have to hire somebody to help with the kids, or John's going to have to cut back on work hours. So either way, John loses money. So we need to make sure that John has some protection here as well. Okay. And that's how I do it, guys. And that's kind of how I paint the picture. And then I say, okay, so John, you qualify for the full mortgage payoff, which is $400,000 over the course of 30 years. And that's $150 a month. And then you qualify for $200,000 with a $200,000 accidental built in. And that's going to be total for the 2 products. That's going to be, sorry guys, total with the 2 products, that's going to be $100 a month. Or you can go with a small policy that's going to give you a few years of mortgage payments. And maybe we're going to do 100,000. Okay. And that's going to be $80 a month. Okay. And we can talk about how I figure out what they qualify for and why I come up with the 3 different options. And it's really going to be client specific, depending on what their specific situation is, their age, their medical stuff, all that stuff is going to take, we're going to take into consideration. So, but let's say I lay out those 3 options. I do the same thing for Mary. And then I say, okay, guys, which one makes the most sense for you today? And then I shut up. And then they're going to think about it. They're going to talk about it to each other. And they're going to usually take the middle one or this one. Okay. Whatever one they decide, as soon as they say, okay, we think we're going to go with the 400,000, or we think we're going to go with the 200,000, then you're going to say, okay, great. You're already pulling up the application. So you're already logging into America or Mutual of Omaha. And then you're going to say, okay, John, Mary, can you go grab your driver's license and we can start the application. If they start protesting, then you want to say, okay, guys, remember, we're not buying insurance today. All we're doing is getting you qualified. Okay, so we can't make any decisions yet until we know what you qualify for. So let's get the application submitted. It takes 10 minutes. And then once we get an approval, you guys can decide if you want to buy more, if you want to buy less, or what you want to do with it. You have 30 days to make that decision. But right now, the only thing we're doing is getting you qualified. And based on what we just went over, it makes sense to make sure you guys have something in place, because we know that both of you are going to be in a bad situation if something happens to this house, and the kids are also going to be in a bad situation. All right. And then I pull up the application, and like I said, I just start typing it up. So that is exactly how I do my in-home, and I do it the same way every time, whether I'm in somebody's house, whether I'm doing it virtually, or whether I'm doing a telesale. You guys can follow this, or you can change it up, or you can do whatever makes you feel comfortable, but I hope this was helpful.